All right. Welcome to the Hart Investment Group weekly roundup. I'm Scott. That's Ben. Let's
Hello.
kick it off. It was a short week. Oh wait, were the markets open on Monday?
Yes,
Oh, they
it
weren't.
was
So,
short week last week.
oh, okay. All right. Well, it wasn't that
Qu-
short then.
Quieter, maybe, in the market's perspective,
Yeah.
a little bit.
Yeah. Exactly. Okay. Well, let's get going here so we can let everybody go for their beautiful weekend.
Yeah,
Uh,
it's
um,
amazing.
Tell us what happened over the last 5 days or so.
Yeah, I think it's definitely lots happening. We spoke this morning after I listened to kind of an update from Hugh Henry. Hugh Henry was a portfolio investment manager that successfully navigated the subprime markets, and so I had some interesting comments around where we are in the cycle. Certainly talked about leverage and debt. And what that means relative to the 70s, because you got lots of people thinking it's the same time frame, same kind of period. So had some interesting comments around that, around risk in the Japanese banks. He talked a little bit about the Japanese banks borrowed euro dollars, which is effectively US dollars, and gave it to Chinese companies. And so, interesting point around what's going on there. Buffett was in Japan the last couple of days talking to the banks. He's got some big holdings there.
Mhm.
So, interesting interconnected thread. So lots going on, but more than anything, I guess, from what happened to the economy. Well, the Bank of Canada came out this week and they didn't do anything, which is what we expected, is for them to continue to stay on hold. And that really didn't change too much. Certainly today we had U.S. retail sales, which I'll give you an update on when we go through the presentation. But and some earnings, U.S. Financial earnings today, which were better, a little bit better than expected.
Yeah. Also noticed that Elon Musk has been pleading for everybody to slow down on the AI, and now it's come out today that he's actually planning a competing company in the AI space. So I think he's just trying to give himself a little catch up time there, eh?
A little heads up. He was one of the founders of ChatGPT, though. I'm surprised he's not still involved with them.
Yeah,
Uh, yeah.
who
So
knows? Who knows the real
yeah,
story behind that? But yeah, I thought that was pretty interesting.
Amazon yesterday too said that they're actively involved in AI and spending billions on AI development.
Hmm.
Yeah.
Yeah, it seems to be the thing du jour, right? The topic du jour. So
Really is. But as we talk about it, still lots of people don't use it, haven't used it. Talk to lots of clients that working, retired. The ones working, I'm still surprised they've never tried it, but lots of people I've spoken with at all different levels haven't tried, like ChatGPT as an example. Obviously, there's lots of them out there, but that one seems to have the most functionality presently.
yep, exactly.
Yeah, yeah.
And actually, that'd be something interesting for people to do. OpenAI is actually you can get on ChatGPT for free. So if you go on, I think it's OpenAI.com or something like that, or just Google OpenAI or ChatGPT, sign on and then just give it a try. Right? It'll can help you with anything from writing emails to uh, legal documents to really pretty much anything, right?
Writing code, developing apps,
Yeah, yeah,
totally whatever you want. Yeah, exactly.
exactly, exactly.
Mhm.
Anyway, okay, so what kind of numbers do you have here for us
I think we
for the
got
charts?
four or five. I can't remember. Can't remember.
4 or 5 or 7?
I think it started as originally it started at two or three, but then as I saw things pop up throughout the day, I had to add them in there.
Okay.
Yeah.
Well, let's get rolling.
So can you see that? Okay.
No, because Ben has
Yeah.
started screen sharing.
Mm-hmm.
Oh, but you look frozen actually.
Okay.
You now we just see your face and it's frozen.
All right. Let's try again here. You can hear me, but I'm frozen. Interesting.
Correct. The new one. That's a new one. Here, let's
What is the new
go. Turn my video back on. You see me okay?
Yep, no problem.
Okay.
I might have to go out and come back in.
Okay, you can do that
Okay.
if you'd like.
right.
I will keep it going
Be right
here.
back. Be
Okay.
right back.
Okay, well, it's been tries to fix those technical issues here. A couple things to note that we can mention here. Obviously, it's still tax season and CRA strike looming. So if you have any need for any tax documents and you have not received them yet, then certainly let us know and we can just email those to you directly if you can't get online or you don't see them there. We can definitely do that. The other exciting thing too is we have a new associate starting with us in the next 2 weeks, I think, 1st of May. So that'll be exciting to help you out with your customer service needs. So we're excited about that as well. And as usual, if you have any questions during this, just there's a Q&A section down below and you can type in your questions there. And
Hey
Ed's
there.
back. Perfect timing.
Was it? Good.
Yeah.
Good. Let's see if
I
we
mentioned
can,
tax docs and I mentioned the new associate and the Q&A. There we go.
Okay, super. We see it now. We're working.
Yeah, we're on. We're on.
Frozen with my hands in the air.
Yeah.
So this was U.S. retail sales came out this morning. Obviously, lots of attention paid towards it. The numbers were pretty bad. Is lowest level since May of 2020, which was a pretty bad time in retail sales. Of course, nobody was doing anything, so pretty bad numbers. As I've seen some of the retailers come out, yeah, I would have expected there would be bigger downward revisions for the next couple of quarters. So I expect we'll continue to see soft numbers out of retail. And yeah, JP Diamond spoke today. JP Morgan had reasonable numbers. And if you read some of the transcripts and comments, he said, I'm not sure if retail sales and consumer sentiment is going to continue to be bad, which is pretty shocking on the back of one of the worst retail sales numbers in a very long time. So, I think that nothing's really changed too much in the narrative with this, but pretty bad numbers from retail sales this morning. So other thing, we had continue to have lots of questions on rates and interest rates. So this is a look at what the Bank of Canada is presently priced in, or at least what the market's priced in for the Bank of Canada. If we look at where we are today, kind of 4.5% overnight rate, which is the current, and then April, there's a comparable of March 8th, what the market was saying versus April 10th, which is where this was when I pulled it off there a few days ago. So, coming into March meeting, the market anticipated another hike, but that's effectively gone to cuts forecasted into sometime later this summer. Guess we'll see if the market's right or not. I would tend to line up with that as the data continues to slow in both growth and inflation. And so if we look at that, that's presently what it's showing. Let's question about jobs. So I've been speaking with clients and colleagues just about jobs, the jobs market, and historically we get a big jobless spike into recession. But I think we're coming into a different environment. Certainly, demographics plays a part in this, but also we are on the backside of a period where you had massive unemployment through COVID, and then everyone back to work. We get demographics, but in Canada, we also have immigration. So if you look at the labor force changes, and since July, labor force has increased about 413,000 new people coming into the workforce. and employment was only up 386,000 jobs. So obviously it's still a positive number, but there's still a mismatch. And so I think that the numbers and the data, I don't think the bank's going to get the big jobless numbers they're hoping for. It's lagging data anyways. But I think growth and inflation will ultimately be the thing that forces them to talk about the rate cuts. And so a few other things, just I guess on the positive side of things, I've been talking for probably a year now, just about the differences between where the economies of the world are. And so when we look at China, they went into the contraction first. They dealt with a lot of the financial pain, and now they seem to be reaccelerating. Their numbers seem to be getting better. And if we look at this chart that I put up here, the white line, this is the China credit impulse on a 12-month basis. So if we look at what that means, ultimately, the white line here, you get an impulse and you get kind of a spike in, this particular one is semiconductor sales. And so if we look at this this is from 2010, every time you get a reacceleration in credit, and this is what we've seen here in China, is credit's expanding. Look, and I believe it'll continue to expand. And this is semiconductor sales down here in the basement effectively. So, what does this say to me? A couple of things. One, that some of the semiconductor stocks are probably underpriced. And if we look at the index, it's been beaten up pretty bad. So that potentially presents an opportunity. But also what it does, it shows there's a likelihood that this credit impulse will drive tech in a positive way. So continue to watch this, but interesting to have a look at that chart. So two more things. So I put this out before. This is non-commercial. This is futures for non-commercial net long or net lending positions against the different asset classes. Ultimately, what it means is just how individuals are positioned that don't need to hedge. So speculators, so to speak, or hedge funds and institutional managers. And so one of the big things that was here 2 weeks ago, I think, when I posted this, is if we look at the US 10-year bond, so that's the bonds maturing in 10 years in the United States, that's kind of out the curve. And we look at what we're seeing right now, we're seeing a max short position of 628,000 contracts. For me, this doesn't make any sense. The economy's slowing. The market continues to show us that they think rates are probably going to go lower on the 10 plus years. And you got a massive short position on that. So at some point, I think we're going to see that switch, and you get the speculators start to reverse this position, and you got kind of max long position of 238,000. So you could get a massive spike in that US 10-year bond quite quickly because of the positioning right now. The same if we look down on the Canadian US dollar. Again, we're having, from a positioning perspective, you got max short US dollars versus CAD. So, that means typically what that would mean here is that the US dollar is going to go up against Canadian dollar at some point pretty soon. And the last piece that I put up here is, so we've talked a number of times just about Raoul and Powell and GMI, which is the global macro investor. Raoul's very big on just where we are in the cycle, kind of looking kind of longer term, where I talk about a lot of the hedge eye data. It's really short term in nature, 2 quarters behind, 2 quarters ahead. And that's really kind of the tactical thinking. But when I look at some of the information that comes out of Raoul and his team, it's more a little bit longer term in duration, probably 12 months to 3 to 5 years, and just thinking about some of the cycle that could happen. And so this was, I thought, a pretty interesting piece where he talks about some things that the media seems to be talking about. Kind of governments could default on their debt. Well, it's, again, extremely low probability, with the exception of maybe Argentina. But the major currencies of the world, they're not going to default on the debt. They're just going to find a way to print more money and find a solution to kind of heal some of their debt issues. And the biggest and likely solution is rates come down. And so the kind of thinking around what central banks are going to do here, or what they should do here, he continues to suggest that there's a feeling that central banks want to continue to put pressure on this inflation number, and it's a bit misconstrued around what they're going to do. they haven't changed. The likelihood is they'll continue to do what they've always done, which is stimulate and cut. That's what they did about a month and a half ago when there was strain in the U.S. financial system, and we need to think about it from that perspective. So this is a good little piece that I thought talks about these things. The last piece, which I'll hit on before we just go and see if there's any questions and then wrap up, is just technology, and the pace at which it's moving now is extremely quick. And technology is inherently deflationary. So all these things that we're seeing coming out, all the different systems that are happening, AI, machine learning, these are all deflationary in nature. And so where we've got kind of the short-term wage pressure, ultimately this results in my view that rates go lower, because a lot of these advances are actually deflationary pressure in the global system. So that was it for today. And just thought to give you kind of a quick update around the thinking, because I still believe that's the case. Technology is leading. There's some really interesting companies that are worth looking at and investing in, and we continue to spend time looking for those.
The only thing that I really noticed out of the last slide was the curse word in it.
Oh,
actually, there might have been a couple in there,
We better not put that one out then.
No, I think it was pretty accurate. The whole document was pretty accurate. So, okay, great. So, what are we looking forward to for next week?
So just from a client perspective, tax wise, there's still some people wrapping up their taxes. So if there's something that you need that you haven't got, please do let us know. We've sent out a ton of gain loss reports and foreign property reports and tax packages. We had some system issues, so we had a few clients this week that couldn't get access to their tax stuff online. So if you have any issues, certainly let us know. From a market perspective, what my big picture view hasn't changed is that we still see growth and inflation slowing. With that as a result, on a day like today, we saw kind of bond yields move to the kind of top end of its range. Gold and miners moved to the bottom end of their ranges, but nothing broke. So I'd expect we get a recovery in bonds and gold and miners next week. Anything outside of that would cause me to maybe rethink a few things, but otherwise, that's what I'm seeing ahead.
Okay, great. Any parting words?
That's it. Everyone enjoy the weekend. It's supposed to be nice, sunny.
Beautiful. All right, everybody. We will see you next week.
Sounds good. Thanks. Take care.